All right, folks, today I had to bust out the red shirt because we are going to be covering the fastest crash in recorded history for new home sale prices has just been confirmed. And if you're wondering if it looks like I have a military cut and I look like a clean-shaven Marine, well, that's because I look like a clean-shaven Marine after my barber butchered my hair and gave me a nice military cut, flat top, not what I asked for. And then I butchered my beard. I went to shave my beard and then I messed up. I took my sideburns or my cheek line. I took too low. So I had to just shave off the full thing. And it was perfectly lined up for me going into the barber today and then just giving me the straight military cut. So we are at your service, ready for duty. And let's get rocking and rolling right on into the update, folks. This is a real estate update. Couple points on current events, but I'm going to start here with a little fundamental breakdown on why we're in this current situation and why, with 100% certainty, I can come on here and say that one, a real estate reset is underway. It's been confirmed and it's going to get a lot worse actually. And then that the equities and the assets across the board for businesses and for stocks, right? This is all going to correct as well. So let's break it down fundamental level to get started here. I put out this tweet last night. Almost 4 decades of rates above 4%. This is for your Fed funds rate, okay? This is the main lever that the Fed has other than money printing to kind of control the direction of our monetary policy and the broader economy. So almost 4 decades of rates above 4%, and they had to take it all the way to nearly 20% for the Fed funds rate to stop the inflation crisis of the 1970s. This time around, taking us from 0% to 5% at the fastest pace was the solution. Now, if you recall, during the simulation events of 2020, that's when they dropped the interest rates to effectively zero. It's about a quarter basis point or so, but it was dang near 0%. And that's when your mortgage was at 2 and 3%. Folks were locking in 30-year fixed rate at 2.5%. What a deal. And now we turn around and we're up at 5%, and they did it at the fastest pace in history. Some might call that a rug pull. I call it a rug pull of Main Street. And now we have trillions of dollars worth of debt that must be reset. Unfortunately, by the time the Fed starts cutting rates, most will be bleeding out in the streets. Folks ask me what I am doing to prepare, and it is very simple. I'm getting liquid with cash, building relationships. That costs nothing, by the way. That's just effort and work, showing up every single day. And then along with that, I am stacking utility with no counterparty risk. That is what I am doing to prepare. And as I'm saying right now, many folks are waiting around for the Fed to cut interest rates. Well, the Fed is only going to cut interest rates when the economy can no longer take it, right? And this is going to be after max pain point event. And as I'm, describing, you're going to be bleeding out in the streets. Basically, you're going to die. And the Fed showing up, the medics showing up to save you after you have no chance of survival in most cases. Now, if you prepare, if you get locked in with what I'm doing, getting liquid, building relationships, and stacking utility that's not going to go away, no matter whether the recession's going up, our economy's going up, or we're going down into a recession, the utility that I'm stacking, the commodities, the XRP, the real estate that we're going to go buy is going to still cash flow no matter what the economy's doing. That's what I'm stacking up right now. Now, to look at the chart here that I shared, though, so that I can reiterate the point, for nearly 4 decades, basically from 1964-65 all the way until 2001, all the way out here, we effectively were above 4%. And for most of those years, you can see we were all the way up above 10%. During right here in 1981, that's when we went all the way up to about 19%, nearly 20% Fed funds rate. And that's what they had to do to kill off the inflation that we got during the 1970s. But as I was saying, you can see we went below, back down to about 1% after the dot-com bubble crash. Okay, the dot-com bubble came in right here. We crashed, and they took the Fed funds rate down to 1%. Okay, then after that, we started to raise rates all the way back up to about 5% once again, and then they flatlined here. This is the key part to understand this. They flatlined, they hit a plateau in 2007, right? At the end of 2006, all the way through 2007, and then they start to break down all the way through 2008. But what was happening? Lehman and everything else, right? The whole world was going to hell in a handbasket during the great financial crisis. That's when the Fed started to cut rates, and they took it back down to 0 in 08. Now, they basically flatlined Fed funds rate. We're at 0% for about 5 years, right? And then during Trump's term, that's when the Fed started to raise it into 2018. And we started to get a little bit of a pullback there in our economy. Things started to cool off from the Trump bump because the Fed started to raise rates to 2%. And you can recall at the time Trump was saying, that we're raising rates too fast. Ease up on us there, Jerome Powell. And then we got the blessing of 2020, I guess you could call it, and they took it back down to 0%. So like I said, by the time the Fed's cutting rates, that's when we're already getting killed. That's why when we're begging for mercy. And in 2020, that's when they took it back down to 0. That's the most recent time that we've been that low. And then in 2022, that's when we started to raise rates. And over the course of the last year, we raised them at the fastest pace from about 0% up to 5%. And this is why I'm saying that a real estate reset has been confirmed. Does it mean that every market is going to crash? No. Can you find markets across the country that are up 10% year over year? Absolutely. Plenty of them. There's still a supply shortage. There's a shortage of good quality housing in neighborhoods that people actually want to live in. Now, there's going to be a flood of overbuilt cities and over-leveraged investors that are going to be dumping properties into some of these markets that are already crashing by 18% in Austin, Texas, and others. Boise, Idaho, already significant pullbacks from that all-time high. So I want to share a couple data points, then we're going to get back into real estate, though. But I wanted to start off with that fundamental basis on why we are in the situation that we're in, right? Historically, we've always been above 4%. For nearly 15, 20 years here, we got a zero interest rate policies. It was the cheapest debt that we've had. And this is what led to the everything bubble. See, it's not just real estate like it was in the 2000s that really blew up into a bubble. This is the everything bubble, right? So we're in the middle of that collapse, and it's actually led to war. I've always talked about it's a currency commodity war. And then it's also reached the point of kinetic battle in the real world. And so I wanted to share this data point. This is a good news here to start off the show with. Israel-Hamas war ceasefire extended by 2 days. Mediators say as more hostages leave Gaza. This was an exclusive update from Wall Street Journal that came out earlier today. So that's good to see. Love to see it. But we are also seeing that the cyber attacks are picking up as we have a huge suspected cyber attack against Israel underway. All Israeli emergency services and lines are currently in blackout, making it impossible for Israelis to reach police, ambulances, firefighters, and rescue teams. Also, we got to watch the water. Pennsylvania water system hacked by Iranian-backed cyber group. So we're seeing multiple cyber attacks, and it all fits right into my program, right? Utility with no counterparty risk. That's what I said I'm stacking, right? Well, it's also blackout barter. When the systems go down, when it's a cyber attack, when whatever happens, I can still transact with this, and I have no counterparty risk. That's why we're stacking it. It's also a good store of value as well. Now, speaking of store of value, if you would have stocked up on some of these food and essential items, you would have been saving substantially, because we look at this. To put it into perspective from Bloomberg, it's a huge slap in the face, and I'm surprised that some people are saying inflation is coming down. For the average person, the real people that have to go to the grocery store and have to fill up the tank and have to renew the lease on their apartment, they are finding that it's an absolute slap in the face to say that prices are coming down after we've seen a historical rise in prices over the last few years. Just because something's ran up, let's be simple, something ran up 100% over the last 3 years, and now it's down 5%. It's on sale. Everyone should feel relieved. No, we're still up, 90 plus percent, 100 plus percent inflation on some of these items over the last couple years. And so this is from Bloomberg. They're sharing this from the grocery store. January 2020 prices compared to October 2023. This is for your orange juice, your soda, your coffee, white bread, the essentials, right? You would have paid $45 for this grocery bill back in 2020. This same bill would cost you $60.90. And this is $15.56 more, which, for many people like myself, you don't notice this stuff, right? Until you add up at the very end, right? You're picking up these items one off the shelf. Your bread costs you $2. Okay, not a big deal. Well, back just a few years ago, that same bread was $1.35. And when you compare the inflation rate here, $15 more on your $45 bill is 34% inflation. So that's the real inflation compared to the 3% headline number that they're running with right now. That is so far from the truth. Now, Sam Callahan shared this as well, too. Bloomberg shared some evidence of the cost of living crisis many Americans face today. And as you can see, since 2020, groceries are up about 25%. What have we been saying, right? Anything that matters, inflation is at 20% or more. Home values up 42%. That's what zero interest rate policies will do. Electricity bills, 25%. Natural gas, 29%. Rent, 20%. Used cars, 35%. Now, remember, if we're looking at Paul Krugman, talking head pundits on CNBC and these other economists, doofus morons that, the only reason why they put them up there is because they're just shills for Main Street. They're, shills for Wall Street, shills for the Fed. They strip all of these data points out of their out of their inflation gauge. They call it the super core, which strips out food, energy, shelter, used cars, insurance, childcare. They strip out all of it, everything that matters. And they give you the super core. Super core is down to 2%. Yay. No, when you look at the real numbers, car insurance up 33%. Used cars up 35%. This is what the average middle class person needs, is a starter car to get them to work. From point A to point B, a grocery getter now is going to cost you 35% more. Childcare, 32%. Food at restaurants, chicken dishes, 32%. Burgers, 23%. Pasta, 14%. Pizza, 17%. Meanwhile, instead of addressing the problem, the government is worsening it and choosing to gaslight the public by saying this Thanksgiving was the 4th cheapest ever. It is an absolute joke. Now, I'll tell you, yesterday I took the family up to Vancouver, and we had dinner up there. It's unbelievable. First off, they put mushrooms in the mac and cheese. Let me know in the comments what you think about that, but I couldn't even believe it. Mushrooms in my mac and cheese? Pass me with that crap, man. Okay, so mac and cheese with mushrooms in it, by the way. Got to add that. What else did we get? Nachos. Okay, we weren't having a full dinner. It was just a little meal that we split a couple plates between the family. The only full meal that we got was the mac and cheese plate with mushrooms. Mac and cheese, nachos. I got a couple beers, and the bill's $100. Now that's Canadian, and so U.S. exchange rate's not as bad. But I mean, golly, we didn't even get any full meals. A couple beers and a pop, and we run up with a Happy Meal up to $100 just to take the family out to eat. It is getting out of control. And meanwhile, they want to toast that it's 3% and we need to be celebrating inflation. And I want to show you a data point here to reiterate what I'm talking about. David Rosenberg, he's picking up on the data point that I'm about to share with you guys. The new single-family home median sales price has had the fastest crash in record. And David says this, let me know how the sticky inflation narrative is working out when median new home prices in October sunk a record 18% year over year, taking out the worst pain point, 15%, we saw in the Great Recession. Now, this is so out of touch to say this, right? This is what the talking heads are going to run with, though. They're going to say, well, inflation's coming back down. Now we have deflation. Everybody should be worried because prices came down 18% on a new home year over year. Okay, first off, that's one data point, but they still have a long ways to go with the new mortgage rates at 7.25%. And this is the same thing that they're doing with the mortgage rates. Mortgage rates went up to 8% here recently. Now they're down to 7.25%, and they're expecting all of us should just be running out of the house to go, buy a new house. We should be lining up and participating in bidding wars to fight over a house. And we should be cheerleading that, yes, inflation is no longer the problem. Prices are coming down, and this is good. No, this is bad, right? Because think of all the people that just bought a new home last year that are basically down probably 15 to 20%. Maybe it's actually even more because I'm about to break it down. We're going to look at the details of this data point and why it's actually worse than what they're reporting. But they then flip this around and want to tell us that we should be glad that inflation's coming back down because now you can buy a new home for $410,000 compared to $450,000, even though the average payment in 2021 would have been, $2,500, maybe even less. And now the same payment there on your $400,000 home is going to be $3,000. So you're still paying $1,000 more per month, but inflation's coming back down. This is how they distort all of the data to fit their narratives. And speaking of this data, let's dig in here. Nick Gurley is the one who shared this. Home prices for builders just crashed by the fastest level on record, down a massive 18% over the last year. This is the biggest annual decline in new home prices going all the way back to 1965. Folks, this is incredible. I mean, when you see data points like this, it really confirms the crash is here. A correction is here. Are all markets going to go down? No, absolutely not. Absolutely not. But I believe that this is one of the best indicators for real estate because this is the real activity, right? The people that are actually willing to get a deal done. Someone who has a used home or an existing home that's trying to sell their house, right? They're not willing to get a deal done. And that's why the houses aren't moving. You're seeing a lot of new homes that are moving. They're actually still selling because these builders are offering additional incentives along with dropping the price as well. So this is the biggest and the fastest crash for new home sale prices on record, going all the way back for over 50 years. We haven't seen a data point like this in 50 plus years. And this time, as I've been saying, this time it's different. This time it's a whole heck of a lot worse. Okay. Now, to be more specific, the median sale price of a newly built house dropped from $497,000 last year to $409,000 this year. That 17.6% drop is the biggest annual decline on record and erases close to half the gain in builder home prices since the pandemic started. I wonder if those home builder stocks are still trading at all-time high, by the way. I should go check on those. Those things were so overvalued. But the true decline in new home prices is actually much bigger because of mortgage rate buy downs. This is what we're talking about. You got to look at the details. In some cases, builders are offering 2.99% intro mortgage rates and buying down the full term to 6%, an incentive that could be worth up to $30,000. So not only has that average price on the new home gone from $497,000 to $409,000, with additional rate buy downs, you could be dropping that price by another $20,000, $30,000, down to $390,000, $380,000 for that new home. Now, here's a great example of these builder cuts. A new build listing in north of Dallas. Price has been cut by 15%. Builder is also offering a mega low rate of 5.1%. And the house is still sitting. Now, this is at $539,000 right now. And this is in Salina, Texas. So a great market here. And in Texas, what we've noted is they've had a huge population increase. A lot of people coming in who, brought up the median income some, but the home prices way outpacing what the average person there in Texas can afford. And then the other scenario that's matching up and coinciding there is Texas has the most amount of new home construction being developed as well. Same with the apartments as well, too. Of course, these aggressive cuts by builders have worked into bringing some buyers back into the market. New home sales registered 679,000 annualized in October 2023. That's down almost 33% from the pandemic peak, but it's roughly back to pre-pandemic levels. Here's the way I would think about what's going on with the builders. They're telling you where the broader resale housing market needs to go in 2024 and 2025. This is why I'm saying Nick is so right. This is one of the best leading indicators of where the housing market's going. Because if the new home is now selling next to the same price as an existing, or even, starting to break below, then the existing homes are going to have to come down in price as well. Prices down 15 to 20%, mortgage rates down to 5 to 6%. That's what's needed to bring buyers back. Or incomes need to go up, which let me know if you think that that's going to happen, right? But of course, existing homeowners are only starting to get the message. These folks are holding on to this. You think the XRP investors are emotional? Existing homeowners, with all their wealth tied up into one or two homes, they're not willing to let this deal go. And they can't afford to, right? Because then they got to move, and then they got to go get a rental, or they got to go buy a new house with a 7% mortgage rate. Can't be done. With home resale prices down only about 3 to 5% from peak, And it's the home resale market which truly influences prices in America. It's 6 times bigger than the builder market. So although it is bigger, right, I think that you got to look at this new home sale as a leading indicator of where the existing home sales are going to go. Another interesting thing to think about are the regional impacts. Builders build almost exclusively in the South and Mountain West, states like Texas, Florida, Tennessee, and Arizona. These are the states where home prices could be most dragged down by builders. I also want to add, look at markets like Dallas. Dallas Metro just banned Airbnb short-term rentals. So what do you think that's going to do? See, not only do they have a record amount of new units coming online, apartments and new homes, but now you have thousands of short-term rentals and Airbnb properties that are now going to be back on the market as long-term leases or they're just going to sell. So you have thousands of units that are now coming online on top of the already, tens of thousands of units that are being built out in the Dallas-Fort Worth metro. So if you're looking for a deal, they're willing to wheel and deal down there in Texas. I'll tell you that right now. Compared to where I live, the prices are still, much more reasonable compared to where I'm at. But these are the states where home prices could be the most dragged down by builders. Like I said, add in these markets because it's not just Dallas. Look at other metros that are considering short-term rental banning. That's another key indicator for where you could find incredible price discounts. Alternatively, single-family builders are basically absent from the states like Illinois, New York, New Jersey, and some parts of California, i.e., why prices are still going up in some of the suburbs surrounding, look at Illinois, surrounding Chicago, right? Folks want to get out of Chicago, so the suburbs still going up. Look in the suburbs of New York, they're still pumping. New Jersey, same thing. Look at Syracuse as another market that's still up. In some parts of California, well, absolutely. Same thing up here in the Pacific Northwest as well. Implying that their fervor, and speaking of jacked up markets up in BC just yesterday, BC's nuts. It's crazy. Implying that their fervor to cut prices and offer mortgage rate buydowns won't have as big of a downward impact on these markets, right? So there's some of these markets. Not all markets are created equal. Some of them are still going up. Which states could be hardest hit by the builder price cuts? I'd watch out for the areas with the highest housing unit growth rate. Hello, Utah, Idaho, Colorado, Texas, and Florida. And some of those markets are markets that I'm actually looking at building out our investment portfolio, looking at some of these markets very closely. And how about the neighborhoods that are seeing the biggest downward push from builders? In a metro like Houston, it will be on the western and northern edge in areas like Katy, where housing units exploded by 36% from 2016 to 2021. Go to Reventure app to access data on housing unit growth rate as well as trends in home prices and inventory in your area. Type in your zip code to see what the data says about your market. And I have subscribed to Nick's Reventure app, and I paid for the subscription to get all the premium data points as well, so that when I'm looking to buy, I know if I'm buying something that's reasonable in my area, and then it's also helping me pull data points for investment opportunities as well. But the bottom line, to wrap this whole thing up, folks, it is without a doubt that a real estate reset is being confirmed. Can you pick one data point and look at this new home sales and say that a crash is here? Yes, you can. New home sales prices have crashed at the fastest pace in recorded history. Fact. Can you also cherry pick suburbs throughout this country that are going up 10% year over year still? Yes. So you have to understand your market. It's just like when you go to invest in any investment, any cryptocurrency, any stock, right? You have to understand your risk tolerance, your expectations, and it's the same thing when you look at these markets. When you look at residential versus commercial, when you look at different segments or sectors of commercial as well. So make sure that as always, when I do these real estate updates, I like to, pick data points like this that are more generally speaking, but then we have to dissect it, look at the details, and look at how each market is being impacted specifically to get a clearer, look at what's actually taking place on the ground. But I've been saying this, and I'm going to continue to say this. Now is your time. If you're looking to go buy a home, to go beat up the builders. They're willing to wheel and deal. The existing homes, the boomers, The boomers in their, we call them boomer fart boxes. They're not willing to give up the boomer fart box. Okay. God bless them. God bless the boomers. We love them. They're not going to give it up. No. They're going to turn around and rent it to us little millennials for $3,000 a month. Gotta love it. No, but seriously, Americans lost $5.9 trillion worth of wealth last year, and that's in equities and real estate. And if history is going to repeat, we're due for a significant correction in the equities, and we're lining up for a significant correction in real estate, and it's already started. The data's confirming that. And I say all this to just say, if you're doing what I do, or you're going to have to implement your own strategy. I'm not here to give you financial advice, and I'm not here to give anybody signals to copy. I don't do that for crypto trading. I don't do that for real estate either. You're in a different position than me. So you have to understand where you're at as far as putting a roof over your head. Is it cheaper to rent than it is to buy in your market? Might make more sense. And then when it comes to investments, the ability to invest nationwide is there. The resources are available. So picking a market that's right for the investments that you're trying to make is key, and understanding the long-term growth trajectory of these markets that you're looking at. There's still incredible opportunities, and it's only going to get better from here. Like I said, I'm staying liquid, I'm building relationships, and I'm stacking utility with no counterparty risk while I wait to buy these assets that are going on sale. So for me, I'm looking at some of these new homes in my area. They're starting to come down. The incentives are for real. In one of the markets is one of the neighborhoods in my area. Luxury markets, all basically. They've actually they've started to dip below 700,000, but they were trying to keep them all above 700,000. But they're 700,000 to 900,000, 2,500 square foot homes. Nothing incredible. I think it's an absolute joke. But I saw that they were already offering 4% interest rates on those. And I don't know if those were just intro, if those were lifetime. I think they actually were lifetime rate buy downs. And after you get over a certain price point, you can do what's called a jumbo loan. And so you can get a cheaper interest rate on that as well, too. But you have to be over a significant price to take advantage of that. But what I'm seeing in my areas is the builders are willing to deal. They're starting to drop price already. They're offering rate buy downs. And so I may end up going to beat up one of these builders in my local market here, And I say beat up. What I mean is take advantage of the deals that are going to be coming your way, whether that's for just buying your residence, whether that's for negotiating your rent. Right now in many markets, now's a good time to go negotiate a new lease and get yourself a deal, right? In other markets, you're going to be able to go beat up a builder, go get yourself a new home. I think it's still going to take some time before we see existing homes start to really get discounted. It's going to be forced through a recession, and that looks like it's on the table for next year, or at least a black swan event that at least scares the crap out of everybody. And then that's what's going to take the rates back down once again. But by that time, everybody's going to be bleeding out in the streets. And just like Rothschild said, you got to buy that blood in the streets, even if you are the one that's bleeding out. So stay liquid, stay ready, keep building relationships, and get ready for the sale of a lifetime. And in the meantime, you can stack some utility with no counterparty risk. Hope you sleep well at night. I appreciate everyone for stopping by. If you appreciate this real estate update, make sure you smash that thumbs up. And on the way out, drop me a comment down below and let me know what you think of the real estate updates. Thank you so much. I'll see you in the next one. God bless you all.